In today's video, we are going to look at an individual who is a W-2 employee. He's able to fund a policy with a moderate amount of money. You'll see $10K per year. However, he recently came into a windfall of cash. So what we'll look at is how we would set up or how we would design a policy in a case like this. If you have a lump sum of cash and you want to start your policy off with a big chunk of change and then continue to fund it possibly with an amount that you feel comfortable with. This is a really interesting case study because we get a lot of people like this that feel comfortable funding a policy with a certain dollar amount. They say, hey, based on my finances, here's what I'm comfortable putting into a policy. I want to maximize the cash value, but I also have this lump sum of money over here. What does it look like if I get the lump sum into the policy? And also, what does it look like if I get the lump sum into the policy and then stop, never make another payment after that? We're going to look at both options. So what we have regarding details is a 36-year-old individual. Again, he is a W-2 employee. However, he has owned some rental properties. He has a couple, but he recently sold some. So as a result of selling off some of that property, he has some extra cash in the bank. He's got about $400,000 in cash, so he's in a good position here. Now, he's interested in whole life insurance. He has experience with it, specifically the cash value. What he wants to do is move some of that cash. He's not sure if he wants to move all of it, but he wants to move it into a policy, and he wants to know the best way to do that. An important detail here. He might, keyword there, might want to keep adding money after he gets the $400,000 into the policy. The dollar amount that he might want to continue to add is between $10,000 and $20,000 per year. Realistically, it'll be closer to $10,000 per year. So pretend this is you for a moment. You sell some property. You have about $400,000 in cash. You're interested in a whole life insurance policy, primarily for the cash value. That's why you're interested in moving some of this cash in there. Now, you're interested in moving some of it, maybe all of it, but you're not comfortable just stroking a check for $400,000 right now. Even though it will show up in cash value, you like to keep a certain amount of money in the bank. You've just been used to doing that forever. That's what you want to do. So what if you could set up the policy where you can gradually move that money into a whole life insurance policy through multiple lump sums, have the option to stop after you get $100,000 in, $200,000, $400,000, maybe even more. Meaning have the option to stop when you want to, make the policy very flexible so you don't have to commit to exactly what you're going to do when you start the policy. So his policy, here are the two main things here. It's set up to maximize cash value and then also to make it very flexible because he wants the ability to adjust as time passes. He does not know exactly what he wants to do when starting a policy. He's not coming in and saying, I want to fund $200,000 years 1 and 2, and then I want to fund $10K per year thereafter, maybe $20K. That's exactly what I want to do. He's not at that point, and that's okay. A lot of people aren't. Some are, which is perfectly fine, but he's looking for more guidance here. So what we're going to do is put an emphasis on maximizing the cash value and also making the policy very flexible. Initially, we looked at a couple different companies and products. We narrowed things down to one of the major mutual companies. It was Guardian in his case because of the flexibility. I'll explain that a little bit when we get into the numbers. So here's what we'll look at. Scenario 1, funding $100,000 per year for 4 years, with the option to stop much, much earlier than that if he wants to. He can easily fund $100K per year for 2 years and stop altogether. But first, we'll look at funding for 4 years. And then second, we'll look at $100K per year for 4 years and then $10,000 per year thereafter. That's that minimum amount he is comfortable with. Now, what I will emphasize here is that this is the exact same policy. What we do not want to do, and this is more on the agent and advisory side of things, is we don't want to show these scenarios with two different policies, because how you set the policy up initially will have a major impact on things moving forward. So we'll see the exact same policy, but two different what-if scenarios. What does it look like if I stop after 4 years? And what does it look like if I keep adding 10K per year? And the nice thing is, you do not have to decide up front, which is nice. Things change. 4 years, think back 4 years ago from your life today. Were things exactly the same? Or are they different now? Things were likely way different 4 years ago. Things change as time passes, so we want to make sure the policy can change too. So, what we're going to do, 100K per year for 4 years. Here's an important piece here. Where can your money go in a life insurance policy? We've got the premium and then the PUA rider. PUA stands for paid up additions. I like to refer to this as a cash dump in because it's what will accelerate the cash value growth in your policy. So the premium piece, we have at $10,000. This is our minimum commitment. So this is what he will be billed for when he starts the policy. Quick question. With a whole life insurance policy, do you have to pay premiums for your whole life? No. If it's set up and funded properly, you'll see an example of that when we look at the numbers. You do not have to. You can easily stop after 4 years. You'll see that. But the minimum premium piece, meaning if we want to pay anything into the policy, first we have to pay the premium, it's $10,000. With some of the top mutual companies, your 4 major mutuals, a lot of times the lowest we can set that base premium is right around 10% of our total desired payment. So for example, I'm funding 100K per year, the minimum premium will be right around $10,000. If you do it right, usually what I like to do is make that the base premium and the term insurance rider. If you like technical details on that, I would check out our video on how to design a policy for maximum cash value. But to simplify, this is you. Your minimum commitment is $10,000. You can add another $90,000 into PUAs per year, and it is optional. So you're not obligated to do that. Now, some details here. The premium piece. When you hear the word premium with any type of insurance product, what do we usually think of? Something exciting or something boring? Something boring. And insurance, a claim that is only paid out if something bad happens. So it's better with whole life, I promise. With the premium, it's not better in the first year. The product we're going to look at, the first year, there's no cash value. Or like $300 or something like that of the 10K shows up in cash value. So next to nothing in the first year. However, beginning the second year, so year 2 onward, the premium payment does generate cash value. It's very close to the full $10,000 in year 2, and it does hit a point that as each year passes that you get more than that $10,000 premium back. So it does build cash value that begins to compound and you have access to. It adds to your entire cash value bucket. I always like to mention that because we hear the word premium and sometimes think nothing's going to show up in cash value because it just buys me life insurance. Then we've got the PUA rider. This is the fun part that everyone likes. So our paid up additions rider, I like to call a cash dump in, all years, builds cash value. So really, the name of the game, if cash value is your goal, is how do you minimize the premium piece as much as you possibly can and maximize the PUA rider. And really, it's just knowing the rules of the game and really the limits. It's just knowing the rules that the insurance company you select offers, and then also the IRS, which is our modified endowment contract or MEC limit, which we set up front. So let's take a look at the numbers, shall we? Let's have some fun. So first, we'll look at funding the policy just for 4 years. So what we've got here is as follows. What do you notice here? Well, on the left, first, we see our premium, $10,000. Then we see our PUA rider, $90,000. Add the two together, you get $100,000. So he has that lump sum of $400,000. He wants to get it into a whole life insurance policy What we're looking at here is doing it conservatively over 4 years because remember, he didn't want to write a check all up front. He could do 2 payments of $200,000. That is something we are going to discuss, or we did discuss, but after discussing, he was comfortable with this. Gives him a lot of time to move the money in, and it also allows us to keep that base premium low at 10% of the total yearly funding. If we set it at $200,000 per year, it's going to be hard to get that premium at $10,000 based on the insurance company limits. Some smaller companies allow that, but this allowed us to really get what we want and have a very strong performing policy. That was the big thing. So as we look at this, we've got our total funding, which just tallies up all of his payments. He pays in a total of $400,000 over 4 years. What is highlighted in yellow is when he gets his money back. That's his break-even point. And his death benefit is $2.25 million. That gave him a MEC limit, which prevented a taxable event of, guess what? A little bit over $100,000. So point is the death benefits at the minimum amount, so we don't have to deal with taxation on the cash value due to a modified endowment contract. So looking at this, not bad. We also see we don't pay anything after we get the $400,000 in. This is pulled straight from the illustration. The cash value growth column here in light blue, this displays the net dollar amount you are receiving from the insurance company every year. So, for example, year 1, you fund $100,000. You've got $88,000 in cash value. It's a loss of $11,000 in change. Year 2, you fund $100,000. In the first year, your cash value was 88. You added 100 to that. If you just add 100 to 88, what would you get? You get $188,000 in change. We'd literally just add $100,000 to it. However, it's more than that. It's 190, almost 191. That means, in addition to our $100,000 deposit, we got almost another $2,500 from the life insurance company. It's in dividends and interest. When I say dividends and interest, I'm referring to the dividend piece of the policy, and then also the guaranteed interest we're getting from the life insurance company. And then each year, we see it get better and better. And year 5, here it's highlighted for 2 reasons. The first is because we pay 0 in, so we just see the net dollar amount we receive from the insurance company. Sometimes people ask, why is there such a jump here when I stop making premium payments? The big reason why is because when you make premium and PUA payments, there are fees or loads that come with those payments we make. The insurance company is deducting some of that and keeping it. That's why we see the cash value growth a little bit lower. You would see the same thing if we put a rate of return there. Now let's look at the same thing, the same policy, where we keep adding money. So this is the exact same policy. Look at the values through year 4. And tell me if you notice any difference at all. No, exactly the same. What about year 5? Now there's a difference. 431, 420. Why is there a difference? Zero out of pocket after the 4th year in this option. In this option, you keep adding $10,000 per year through age 65. We're going to look at it through year 30 in a minute. So here, you keep on adding $10K per year. And we're funding just the premium. Could you add more to PUAs with this policy? Yes, which would make it that much better. Do you have to? No. Do you have to pay the premium? No, you don't. Not with a policy like this, where it's maximized up front. So looking at this, what is the policy growing by each year? The net cash value growth is really what I am interested in here. So the premium, the first year, what shows up in cash value? Nothing. That's what takes the biggest bite out of my cash value in the first year. That's why I'm red right out of the gates. However, beginning the second year, I'm not in the red because the policy is beginning to compound, yes, but also I'm seeing that premium come back. The expenses are not what they were in the first year. By the time he's funded the policy aggressively for 4 years, he's 10x the base premium, the minimum for 4 consecutive years. So it's compounding. But when he hits year 5, that premium payment is coming back to work for him. And you can see that here too. So year 4, he's at 405. He adds 10, which is all premium in this example, just about all premium. The true base is like $9,000 and change. Just about all premium. He gets that back, which brings him up to 415. If we just add 10 to 405, but the cash value's 431 and change. Here's the net growth. That's what he received from the life insurance company. A little bit higher than the example where he paid nothing. The reason why is because when you add additional dollars, even premium dollars, you're adding to that cash value, and now you're receiving compounding on the full amount. So we're filling the bucket up more. That's what we're doing. Pretend you got soap going in there so the bubbles just get bigger and bigger because you're adding more to it. I hope that made sense. So it keeps on compounding. We see because we're adding more money, the net dollar amount we're getting is slightly higher. If you added a return to it, instead of seeing it in dollars, you'd see they'd be about the same. This one would actually be a little bit higher. Generally speaking, what you'll see with a whole life insurance policy, if we max fund it and then stop, the internal rate of return, especially long-term, is a little bit higher in the option where we stop. But my point is, both are very similar when we look at this. We can look at it long-term here. I mean, long-term, you've added another $260,000 to it. All right, so let's do this. Get rid of those cash value growth columns. I'm just going to minimize them. Minimize these as well, just so we can see net out of pocket, cash value death benefit, total funding. Let's do this, which will just be this cash value minus this cash value. There'll be no difference for the first 4 years. Then after that, there will be a difference. And there it is. By age 65, he's got $450,000 more. However, what we also need to do is deduct the difference here because he's paid in another $260,000. So what we can do here, just going to do it this way because the difference in payments, $260,000. He technically has, call it $190,000 more in cash value because I would back out the dollar amount I paid in. Some people like to do that, some don't, but I always like to be fair. I don't want to inflate the numbers and make them look good. Look how much better you are if you pay this much money into it. Yes, you do have more money, but we still need to account for the fact that it's your money going in. Anyway, this is how we set up his policy. We set it up so he could stop after 4 years or continue to add money. He can add more than $10,000 per year. He can stop the $10K per year after 1 year, after year 10. He's got a lot of flexibility here. And that's really what we wanted to design the policy like because he was concerned about it. So now he has a flexible policy. He can stop funding it at any time he'd like. He can continue to add to it. He's interested in the cash value for the 3 core benefits, right, which are the safety, liquidity, and also the tax advantages, and then also using it. If an opportunity comes around for more real estate, he's been successful there before, he may decide to get back into it. Right now, he's not really into it because he feels like everything is going up. It takes away a lot of time and attention that he's like, you know what, I'm good right now. Maybe in the future. But he's had success there, so he's got this big cash value balance that he can use like a personal line of credit. So I hope you enjoyed this one. If you did, please let us know. Feel free to hit the like button, subscribe for more, leave any comments below. If you'd like to connect with us, you can check out our website, ibcglobalinc.com, or you can email us direct. And as always, I hope this helps. Thanks so much for watching. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.